Today, folks, I'm going to break down how I would invest $10,000 in the stock market in 2021 as though I'm starting from scratch. Now, I've realized a lot of you beautiful subscribers might be starting with $500, $5,000, but I figure $10,000 is a good baseline. And before we dive into this, let me preface by saying, first of all, a few things. One being, don't act like $10,000 is all you're going to have to invest, because then you're going to over-diversify your portfolio. You should presume as years follow, you'll have more money to invest. Two, even though I'm showing you how I would invest, I would use this as a baseline and go learn from a bunch of other YouTubers, a bunch of other people that you admire, and kind of formulate your own investment strategy. Because clearly, I am not a financial advisor. I'm just some random dude managing $250,000 from his parents' basement, all right? Now, third and finally, I think these are general rules that most of us can agree to, which is how you're going to structure your portfolio and how you're going to balance it, which I kind of preface off these three categories. The first one, by far the most important one we're going to discuss in a bit, is going to be dividends and security. The second category is going to be growth, simple growth in my opinion, and then the third is going to be aggressive growth. So right now, we're going to dive down into the stocks that I would pick and how I would scale out that $10,000 based on everything that we just mentioned. So in the clarity of my transparency, do the channel a favor, smash that like button, folks, and let's jump right into this. Welcome back, passive income investors alike. So let's get into how I would invest $10,000 if I was starting from scratch here in 2021. And we're going to start focusing on the security and kind of dividend side of your portfolio. You can go on to YouTube channels like Dumb Money and watch people leverage $18 million into the market on high risk speculative plays, but even they have a backup portfolio of super secure stocks that protects them in the worst case scenario if shit truly hits the fan. And these are what we're going to call our recession proof stocks, our ride or die to the grave, things you're going to be able to inherit to your grandkids. This is a reality of the market too many people overlook. Listening to YouTubers go on about things like Tesla stock, or even myself talking about MindMed a lot, which we're going to bring the highly speculative stocks up toward the end of this. So the very first stock, if I were to take 10,000 to put into that category of super secure dividend plays, I would likely take about 50% of that 10 grand, maybe about 5,000 or 6,000 of it realistically. And the first stock we're going to start by talking about would be Johnson & Johnson. Now, if you're well versed in the YouTube community, this is a PPCE in favorite, a huge dividend investor out there, guys. And Johnson & Johnson with a 2.65% dividend yield, a PE of 23 does not sound that appealing, but with a $401 billion market cap, you're basically buying into an umbrella, almost an ETF under one company name in the healthcare sector when you're talking about pharmaceuticals like the CV virus vaccine, when you're talking about consumer staple brands like Tylenol that they own. And then finally, they even supply medical equipment to most surgeries that go on across the US. And this is by far one of the safest companies you could invest in. It's been around for over 100 years, guys, and has increased its dividend every year consecutively for like more than 50 years. It's what they call a dividend king. It would be at the top of my list of something that maybe I would throw, let's say, $1,000 or $2,000 at with that 10 grand. Leading me into numero dos, the second stock that I would look at. We're going to kind of shift into a bunch of different sectors of the market as well to protect ourselves here, obviously, guys. But let's talk about PepsiCo, because this isn't the consumer staple brands. These are part of the market that I've only just recently started buying into relatively aggressively, because it does come with a lot of security. I'm sure you've heard of Frito-Lay. I'm sure you have your favorite chips out there like Lay's, Doritos, Mountain Dew.
Did you drink my Mountain Dew? Did you drink my Mountain Dew? Let me smell your breath. Let me smell your breath.
I don't know, but these are the kind of products and these are the kind of companies that, yeah, you're not going to be watching your portfolio grow off this at a 20 or 50% clip year over year, but at the same time, you know, if shit really hits the fan, like it did in 2020, even though these companies took major dips, their balance sheets didn't really change. People were still using these brands and they were still generating income and paying dividends. So you know these things are going to be recession-proof, ride or die to the grave. And with a 2.82% dividend yield, a PE of 28 and $200 billion market cap, guys, this is one that I would put right next to Johnson & Johnson. So there we got our healthcare, kind of our consumer staples. So let's move into the higher dividend yielding stocks. Now, these are where you're going to see probably a lackluster in, say, dividend growth over something like a J&J or Pepsi, but you're also starting with a much higher yield. And I like to call these stocks money for today. These are the kind of companies that'll pay you out fat checks that you can rediverse into any stocks you want and help you start diversifying immediately. And in the next sector we're looking at, we got to add in utilities, guys. I believe utilities are one of the most resilient, safest places for high yield dividend income, because everybody wants to keep the lights on in their house. And these utilities are conglomerates today. They are massive. Looking at something like a Southern Company here with a $63 billion market cap, you might be thinking to yourself, Kyle, well, why didn't you mention any of the renewable plays? Because in this very moment, moment, the renewable plays, like ones I hold in my portfolio, like Northland Power, in my opinion, are just starting to get a little bit richly valued to the point where a lot of the future growth is starting to get priced in. Because you can always go back to the resiliency of something like a Southern Company here that is likely to even get into the renewable space sometime in the future here, guys. And with a starting yield of 4.28%, a 20 PE, this one's actually more cheaply valued than Pepsi and Johnson & Johnson, guys. So these are great places to start if you're looking for that immediate cash flow today, which leads me into the financial sector, by far one of my favorite sectors of all time. More primarily for me, these are stocks that I find personally attractive, by the way. I recommend that you take these sectors and deep dive and find the ones that you personally like. But in the Canadian banking sector, guys, Canadian Imperial Bank, it's one I've held forever. They increased their dividend going into this pandemic, no dividend cuts. I find the Canadian banks are a little more resilient than the US, and I recommend usually buying a diverse portfolio of these. But again, we're trying to figure out what we would do with 10 grand even. And I own Bank of Nova Scotia, TD Bank, but I had to put this one at the top as my favorite, if I'm being honest, with a 5.29% dividend yield, a PE of 13 and a $50 billion market cap. If you look at the population growth in Canada, we are outpacing the US and even India right now. We are growing faster than most first world nations due to a lot of immigrants coming in, which is something I 100% agree with, because not only does it bring more money and expand the economy, usually on the financial sector, everybody needs a bank, guys, and the more people that come in, the more bank accounts that are going to open, the faster you're going to see growth rates. And the fact that we're almost on the other side of this pandemic, at some point in the coming years, we're going to see interest rates going to go back up. There's going to be further catalyst to kind of give more resiliency to these banks. Now, between these four companies, I would feel very comfortable divvying up 50% of that $10,000, leaving us with $5,000 to focus on growth and aggressive growth. Now, when I say growth, you don't have to think that you're buying into some super speculative stocks. In fact, we're going to start with the safest growth companies that are arguably more secure and have a higher dividend security rating than everything we even just looked at. And of course, at the top of our starting growth list, we got to talk about Apple here, guys. Even though Apple trades at a PE of 40, a lot of people are going to tell you it's crazy overvalued. I'm going to tell you guys, is obviously, aside from the iPhone being a huge success, aside from the fact that Warren Buffett and Berkshire own 50% of their portfolio, 50% of all of Berkshire's money is sitting in Apple. The raw fact that Apple makes so much bloody money a year, could you imagine making like $30 billion to invest year over year, guys? Like, you could just invest into other cash income generating sources. Apple is like the king of the kingdoms. I honestly believe everyone should have exposure to some degree to these stocks. Now, it's like planting a tree. It would have been nice to own Apple, 20 years ago, but if you're just building your tree today, I would add even a little bit, if any at all, when you can. It is a beautiful company. I will always hold this one in my portfolio. And the fact that they're starting to compete with Tesla, Apple wouldn't announce something like that unless they had something really resilient under their belt. Now, yeah, you're only getting a 0.62% dividend yield, but it is the safest, securest dividend you're going to get, and you're including a company that does a lot of share buybacks. So the reason Apple has run so much has a lot to do with the fact that they take those tens of billions of dollars and just keep pulling their own shares off the market, making your pie ever bigger as time goes on. Then my second pick for regular growth, guys, putting aside dividends altogether, would have to be Facebook, which I arguably believe the balance sheet that it currently has is one of the cheapest tech companies, and it also sits in the S&P top 10, guys. Facebook has the real capability to double their revenues over a very quick period of time, considering they haven't even monetized half their platform. And because the media world always likes to villainize Mark Zuckerberg, we always see them sitting in front of Congress and Congress getting very upset with them.
I don't think you have a monopoly.
It certainly doesn't feel like that to me.
Okay.
I believe those negative headlines have led Facebook to having lackluster performance against its peers, which is one of the reasons that I love picking it up, and I would even consider buying it right here. I think the highest share price I paid for it was around $275. The lowest share price I paid was around $170. So I accumulated most of my Facebook around a $200 price range, but even still at the current valuation metrics, just because it's so suppressed, it's so hated, yet it has one of the most resilient balance sheets, the best margins in the S&P top 10, the fact that it hasn't monetized half its platform. There's so many reasons to be bullish on Facebook, which is why I would put it in my safer growth category. And these companies are arguably even safer than all of the really safe, secure dividend stocks that we looked at, because they're much larger companies. They have much higher cash flow. They got a lot more money in the bank that they can use to even acquire other companies, or use that money for, whatever the heck they're going to do to grow the company, because we're talking about tens of billions of dollars here, guys. I would feel comfortable divvying up if I had 5,000 left, maybe even 1,000, maybe even 2,000 each into these. So I would do Johnson & Johnson, Pepsi, Southern Company, and Canadian Imperial Bank. I would divvy 5 grand into those. I would divvy another 2 grand into Apple, a 2 grand into Facebook, and then finally we got about 1,000 left for our aggressive growth. The last $1,000 you have to invest here that I would have to invest, guys, would have to go into this category of extremely aggressive growth because too many people are too scared to lose that $1,000. But in the perspective of life, $1,000 is nothing. Like I told you guys, don't equate $10,000 to being your entire portfolio. You should be investing through your entire career. But what I call these companies, they're like the lottery tickets, they're the moonshoots. If you find a category of stocks you understand that you believe are highly underlooked, even though they do not produce revenues, it might be a good place to park a little bit of capital because you could look at, making a 500, 1,000% return in literally a year. And if you don't believe it's possible, I've done it on multiple occasions now with Canopy Growth Corp, Tesla, and MindMed. And it's only because these are categories that I believed in when other people didn't. And let me clarify this. Do not rush into markets that everybody and their grandmother is talking about. That is not where you're going to get super aggressive growth. It's going to be very hard to make an 800 to 1,000% return off Tesla like I have at its current valuation metrics, guys. You're going to see the growth rate slow down as a lot more people flood into it. So for me personally, the categories that I've been really paying attention to in the market right now has been in the healthcare sector. And this might be different for you, but this is where I'm finding my aggressive growth. And again, you could even find aggressive growth in an ETF. And if you don't feel comfortable managing this yourself, you could hand it off to somebody that you feel will make the right decisions moving forward. And for me, that has been in the ARK ETFs, guys. I recently started buying into the ARK Genomic Revolution ETF because I believe healthcare is going to be the most resilient over the next 5 to 10 years, probably even outpacing Tesla. And honestly, these companies trade at much higher discounts for the problems that they're solving compared to a lot of companies in the EV sector and a lot of companies even in the renewable space right now. And for me personally, my one lottery ticket that I handpicked, of course, was MindMed. So if I had $1,000 left over, guys, I might divvy 500 of it up into the ARK Genome ETF and then 500 of it into the MindMed. If we're thinking with a long-term perspective being over the next, let's say 3 to 5 or even 10 years. The reason we use such small amounts of capital in these excessive growth companies, guys, is because the risk of you losing that money is substantially high. But if it works out and you do end up experiencing 100%, a 200 or even 500% gain in one of these companies, that $500 could really quickly become $1,000 or a couple $1,000, where something like a Johnson & Johnson just isn't going to do that for you. But in the meantime, Johnson & Johnson is going to keep paying you out money that you can use to allocate and continue to grow your portfolio. So you can kind of see how these different sectors of the market begin to balance out the portfolio, and they each kind of have their own specific reasons for being where they are. Now, again, guys, this is just what I would do with $10,000 to invest in the stock market today. And moving forward from there, guys, it's always on the presumption that you're going to be investing more money next year and the year after that. And 10,000 should be a very good starting goal for anybody. I mean, you should say this year, I want to find a way to save $10,000. Get to that baseline, guys, and then build off of that. But I don't like seeing people over diversify right away. A lot of people would just go straight to an ETF, like an S&P 500 ETF. But if you're younger, and again, talking from my generation, if you're in your 20s or early 30s, it's much more appropriate to not overexpose yourself with a smaller amount of capital because you just won't experience the growth or be taking on the risk that would be appropriate for your current age group. So just speaking in generalities today, I passed the question off to you guys. Let me know what your portfolio would be in the description below if you were starting with $10,000 today. I would love to hear your personal picks if you were starting from scratch in 2021. But in light of all this, stay cool, stay awesome, and I look forward to catching you guys tomorrow.